Hi, in this video we're going to talk about investor psychology and motivations as part of the training process for pitch competition contestants. I want to give you a little background on myself. My name's Lee Thurber, and I got an undergraduate degree in accounting from UTA in '82, passed the CPA exam in '84, practiced for a while as a CPA, then got involved in medical, basically the medical business. Ended up writing a book called Modern Optometry, a Practice Management Guide in '88. Went back to school and got an undergraduate degree in account. Went back to school and got an MBA in international business, also from UTA. And this was about the time NAFTA was kicking in. I wrote another book called Mexico, the New Land of Opportunity. In 1995, I started a business called FlashNet. I was the CEO and chairman. And 3.5 years later, on March 16th of 1999, we took the company public under the symbol FLAS. In 2002, I launched a company called NetOffer, which I sold in 2014. It was an online real estate business. In 2013, I was asked to start teaching entrepreneurship at UT Arlington, and I did. And then in 2014, I started a company called Apricot Rocket. About 3-4 years ago, in 2017, I was invited to teach a class on strategy at UT Arlington, which is one of the capstone courses for the undergraduate business program at UT Arlington. In my professional career, I've raised well over $80 million. Now, as we talk about and think about investor psychology, we need to set some understandings of some baselines. And the first thing is the concept of what investors consider high growth. Generally speaking, if your business has been around for 3, 4, 5 years and you think you're ready for investors to give you money, if you're growing at less than 20% a year and basically have been growing or have slowed down to under 20% a year, the most common reaction you're going to get from investors, and I'm talking here about seasoned, experienced investors, is that you have a nice little lifestyle business. And when they tell you that you have a lifestyle business, what they're saying is it's a great little business for you to support your lifestyle, but it's not going to make enough money to justify me as the investor putting money into your business. And so that's the concept of a lifestyle business. A lifestyle business can be a very nice business to own and can grow quite nicely, but if it doesn't have a few certain critical factors in place, then it's not going to be one that's going to attract investor interest. Now, when you have a business that for the last 3 or 4 years has grown at 50% or greater year-over-year growth, you're going to have a business that is going to be interesting, not necessarily going to get investors, but it's going to be interesting to investors because high growth rates are always interesting. If you're in between the two, there's a lot of variables that will determine whether or not investors are interested in your business. But generally speaking, if you're not growing at a pretty doggone fast pace, investors are not going to be particularly interested in your business. Which leads us to some basic growth curves. And you're typically going to see businesses fall into one of these 4 growth curves. Rapid, incremental, episodic, and plateau. We're going to talk briefly about each one of those. The first is the rapid growth curve. This is kind of a situation where you're in the right business with the right product at the right time, you got the right price, everything's kind of going well for you. All the macro and microeconomic forces are favorable, and you may have really relatively little competition and probably have strong customer relationships. You'll notice that in the middle of the growth curve here, it's nearly straight up. Investors love steep growth rates. It doesn't have to be revenue, but it has to be something that can be translated into revenue. So customer acquisition of some sort or prospective customer acquisition, you have to be doing something in your marketing that's getting large numbers of people to come and look at your business. Facebook grew rapidly and for the first several years did not know how to generate any revenue. Neither did Twitter, neither did Google. I mean, there's lots of examples, especially in the technology space, where businesses grow rapidly and don't understand how they're going to generate money, but they get investors because rapid growth is always exciting to investors. The next growth curve we're going to talk about is the incremental growth curve. And this is typically the kind of situation where you have to invest in plant and facilities to be able to jump to the next level. A simple example would be something like Fuzzy's Tacos. I moved to the DFW area in about 73, 74, and Fuzzy's Tacos was on Berry Street in Fort Worth next to TCU or near TCU, and they had one location, and they used to have lines around the door or out the door and around the corner for lunch, and they couldn't do any more business. And it was such a popular concept that the only way they could really grow was to open a second location. That location peaked out, and then they had to open a third, and so on. So that's an example of stair-step growth. Now, if you back up far enough in time and you look at stair-step growth, it can look like other types, maybe even rapid growth curves. But if you zoom in a little closer, you'll see that there's a definite sort of stair-stepping pattern to it, and that's the incremental growth curve. That's, again, indications that revenue can't be increased until you increase facilities that are available for generating revenue. The episodic growth curve would tend to generally to indicate a company that typically would have a small number of very large customers, because you're going to see ups and downs as the company goes through cycles of acquiring customers and losing customers. A good example, a simple example, would be a consulting company that has 10 clients at say $10,000 a month, generating $100,000 a month. Nice little consulting business. You lose a client, you drop from $100,000 a month to 90. Probably not going to cause anybody a heart attack, but you lose 3 of them, and suddenly you're now down to the point where you're starting to have to make cutbacks and get really nervous. And so it kind of boils down to a question of, is it better to have a small number of large clients or a large number of small clients? And the episodic growth curve is kind of typically indicative of a company that has a small number of large clients. The final growth curve would be the plateau. And all businesses, given enough time, are going to eventually plateau. And the basic reason is really fundamentally simple. The world is only so large, a business can only get so big, and at some point it's not going to be able to continue to grow at the kind of steep rate that it might have in its early years. And so on the front end of the plateaued growth curve, when it was pretty steep, you might have had a rapid or an incremental or an incremental growth curve, and then it eventually plateaus out. Typically, the only way that you can turn a plateaued growth curve into a steep growth curve is to re-engineer some fundamental aspect of what the business does, maybe add new products, maybe acquire another business, maybe completely get into a new type of industry with the business. Typically, these things include changes of management teams, because management teams begin to stagnate. So a plateau is a very common for a more mature company, especially a mature company in a relatively competitive and or mature industry. Now, the reason I mention all of those is because I want to now talk about what excites investors. Investors are driven by greed, and I mean that in the most positive fashion. Investors want huge returns. They want better than average returns. They're looking for huge growth opportunities. They're excited by large addressable markets. And we're talking about billions and maybe tens or hundreds of $billions a year in potential revenues within an industry market or segment, as opposed to millions. So, you're going to find investors that'll be interested in owning or helping you start a restaurant, that kind of thing. But, if you're looking at getting investors, you're typically going to be looking at people that are really looking at what is the real long-term potential here. Again, remember, and this is an important thing for you to know, investors need you. Investors desire huge returns, and banks, CDs, mutual funds, stocks, they simply cannot provide the kinds of huge returns that investors are looking for. Really, only startups can do that. Now, investors might have come from a world where they had a startup, made a lot of money, or maybe they came from a more corporate type of world. But generally speaking, they know that the only way they're going to get the kind of 50 times or 100 times or 400 times their money back is if they invest in a startup. And when I say 400 times your money back, I want you to know That actually happens. In fact, when I started FlashNet, there were several investors that put in $50,000 to help get FlashNet started. And they got over $20 million back in about 3.5 years. So 3.5 years, 400 times your money back. That's the kind of story that investors are hoping that they can get into. Greed is your friend. Confidence is your biggest asset. So when you make a pitch, when you talk to investors, you need to be extremely articulate, confident, be prepared, be committed, and be hungry. And tell a good story. Investors love a story about the purpose or the passion that drives you to become successful. They love hearing these kinds of stories. And they're really going to evaluate you as much on how you say and how you perform as much as what you say. The main thing investors, I've seen this happen many times, investors will invest in a person that they think has the kind of drive and energy and hunger that is going to lead to success. And then I've seen those investments essentially get wasted, and then yet the investor comes back again because they believe in the person. And so investors will often invest as much in you as they will your business idea. And if you handle that relationship right, even if you go through a failure, you can actually retain that investor and have them go with you to the next opportunity. It's all about your communication style and what you do. In fact, I had that happen with me. There was an investor that put $40,000 into a business that I had related to NAFTA in Mexico, and because of a peso devaluation, that business failed. This guy lost his $40,000. And then shortly thereafter, within a few months, I came up with the idea for an internet company, the FlashNet. This guy put in $50,000. 3.5 years later, he had $20 million in his bank account. So the point is that investors will often stick with you even through a failure. Now, I'm not going to say they'll stick with you 2 or 3 or 4 failures in a row, but I am saying that investors invest in people as much, if not more, than they do in ideas. So, when you're preparing your pitch, this is the important stuff for you to understand. Now, I've kind of laid a foundation in what I've told you up to this point, but now let's talk about what investors want to know. I've boiled it down to 5 things. Investors want to know what problem you solve, how big the potential market is, how much money you need, what are you offering in exchange, and who are you? They want to know those things. So let's go through them individually. They want to know what problem you solve. And when I say what problem you solve, it's like, is this a big problem? For example, if you have toe fungus, that's a problem, but that's not like an earth-shattering problem. Now, it might be a problem to the person that has toe fungus, but it's not necessarily an earth-shattering problem. Now, it could be that millions of people have toe fungus, and so this could in fact be a big deal. So, and the people that have it, it's probably a very disconcerting kind of thing. It stinks and all that kind of stuff. Now, I'm not focusing on toe fungus. I'm just saying that it doesn't really as much matter. It matters whether the problem is a severe problem to at least some segment of the audience, of the market. What is your solution, and how did you develop that solution? This is part of your story. They're going to want to know how you came across, what motivated you to come across that solution. You want to describe the benefit that the customer gets and basically what the value is, and also how they currently solve the problem. This is a little bit of competitive research. Now, the next thing that investors want to know, and this is really important, is how big the market is. How big is the potential market? How many people have this problem? And if you can throw out some statistical data that tells kind of a big story, this big opportunity, they want to know if you have, a big opportunity. How do you identify the potential customer? This needs to be something that you can readily identify some characteristics so you'll know who to target, because they're going to want to know who your customer is and how do you find them. They want to understand that there's a process that can be put into place that you can just twist the dial, and the more you twist the dial, the faster your business grows. Where do you find those customers? What are the current solutions that they have available? Back to the competitive information. How is your solution better and different in the marketplace? What is your unique selling proposition? And finally, when you come to market, not investors, but when you come to market, your competitors are never going to just sit there and watch you compete. They're going to come up with a response of some sort. So what does the industry look like, and what is the potential importance or impact of that response going to be on you? If you're up against a small number of very large companies that have the ability to just completely overwhelm you with marketing and price reductions and run you out of business, that's something that you need to be prepared to answer, because you'll get questions about that from investors. So how might your competitors respond, and how are you going to handle that response? And of course, they're going to want to know how much money you need. And it's not just how much money you need, it's what will you spend it on? Why will you spend it that way? And how will that spend impact your cash flow? And you can't just toss out some platitudes like, oh, I'm going to spend it on social media. You need to have some experimental data, some research that you've done, some trials that you've done that can demonstrate and show the investor that you're not just tossing out numbers. You've actually played around and figured out. It's actually called cracking the code. And cracking the code means that you have figured out how to spend $1 on marketing and get $3, $5, or $10 back in the next week, month, or 2 months. You need to be able to show them that you have a formula for a message and an audience and a media that'll get that message to that audience, and a message the audience will respond to that ultimately leads you to a profitable sale. And a profitable sale, of course, means one that you make enough money on the sale to not only justify the effort, but also to fuel the engine and keep pouring money in. So if you can basically spend $1 and get $3 to $5 in profit back, or maybe 10 in profit back within a couple of weeks or a couple of months, then you can just twist the dial and start spending more money and grow. So they're going to want basically to know how you're going to solve that, and they're going to want you to connect the dots on enough points so that they know you really know what you're talking about. And then finally, they're going to want to know, not finally, but they're going to want to know what you're offering in exchange. Now, for the grant pitch competition, this isn't an issue because we're going to give you money. But if you're pitching either a banker or an investor, the banker's going to want to know that you're able to pay them back, reliably able, because remember, the number one rule of banks are they never lend you money unless you can prove you don't need it, because they don't want to take any risk. Now, investors will take risk. Investors will lend you money, but they want to know, what are you offering in exchange, and why do you think that's fair? And when I say, what do you offer in exchange, I'm talking about the percentage of equity in your business that you're willing to give to an investor in exchange for them giving you the money that you're asking them to give you. They're going to want you to be able to tell them how much revenue you've generated since you started. How much revenue did you generate last year? What do you expect to generate the next year with the investment that they give you? They're going to want to know that you're on top of your numbers and that you have realistic projections for what's going to happen. And then finally, they're going to want to know about you. Why do you deserve the investment? And this is where your hunger, your confidence, your attitude, your articulation, your poise, all of these things come into play here. So they're going to want to know about your prior experiences, and really, do you have a team around you? Who is your A-team? Who's on it? And why are they your A-team? And how much money have you and your A-team members invested in the business? Has any of your family or any of the A-team members' families invested in the business? The investors don't really know you. And so if they know that people that do know you, like your family and your friends' families, they think enough of you to put a little money in. Now, they don't have to empty Aunt Matilda's bank account and sell the farm. I mean, that's not important. But some indications of support from your close family and friends goes a long way to making investors comfortable that you can, in fact, deliver the goods. Ultimately, they want to know a couple of things: how hungry you are and how committed are you. They want to know that you're, in fact, going to suffer if you fail. So it's usually a really good idea for you to have enough of your own money in your first deal so that they know that if you fail and lose the investor's money, it's also going to hurt at home. And so the answer to what kind of skin do you have in the game is really kind of what they're looking for. All right, that covers the contestant training on investor psychology. Please continue on to the other videos in the series. We're going to be talking about more detail on funding and financing your business. We're going to have a video on cash flow projections. We're actually going to talk about the difference between a business plan and a private placement memorandum, and also talk about those mysterious documents called shareholder agreements and subscription agreements. So be sure and watch the other videos in this series. Thank you for watching.